The stock market is volatile, interest rates are rising, and inflation is still a concern. It's a tough time to be an investor, but it's also a great time to learn about the strategies that experts are using to navigate this uncertain market. In this video, we'll be discussing the top 5 investment strategies for 2024, according to the experts, so you can make informed decisions for your portfolio. Passive index investing. Passive index investing offers a straightforward approach to growing your wealth by investing in a broad market index, such as the S&P 500. Instead of selecting individual stocks, you invest in funds that mirror the performance of major indexes, allowing you to gain exposure to a wide range of companies without the need for active management. This strategy has demonstrated its effectiveness over time. For instance, the S&P 500, which includes 500 of the largest publicly traded companies in the United States, has shown a consistent upward trend. By tracking this index, investors have often been able to match its performance, benefiting from its long-term growth. One of the major advantages of passive index investing is its cost efficiency. These funds typically have lower management fees because they do not require extensive research or frequent trading. The simplicity of the strategy also makes it accessible for many investors. Additionally, the broad diversification provided by these funds helps to spread risk across different sectors, and the potential for long-term growth is significant, as these investments generally follow the market's upward path. However, there are some drawbacks to this approach. Passive index investing does not offer the chance to outperform the market, it merely tracks it. During market downturns, your investments will be affected since you are fully exposed to the index of performance. There are also missed opportunities in specific sectors or regions that may perform better than the overall index. Additionally, tracking errors can occur where the fund's performance does not perfectly match that of the index. This strategy is ideal for beginner investors who might find the stock market overwhelming and for long-term investors who prefer a buy and hold approach. If you are looking for a simple, low-cost way to invest that aligns with the market's overall performance, passive index investing might be the right choice for you. Value investing. In the world of investing, value investing stands out as a strategy focused on finding stocks that are undervalued compared to their intrinsic worth. This approach is based on the belief that some stocks are priced lower than their true value due to market inefficiencies. By investing in these undervalued stocks, investors aim to profit when the market eventually corrects the price to reflect the stock's true value. One of the most famous proponents of value investing is Warren Buffett, whose success has become legendary. Known for his methodical approach and deep understanding of company fundamentals, Buffett has achieved remarkable long-term gains using this strategy. His success illustrates the potential of value investing to generate substantial returns over time, even if it takes years for the market to recognize a stock's true value. Value investing offers several advantages. It often leads to long-term gains as the market gradually adjusts the price of undervalued stocks to their intrinsic worth. This strategy typically has a strong risk/reward profile because it is based on thorough financial analysis and metrics. Additionally, value stocks are more likely to pay dividends, providing investors with a steady income stream while they wait for the stock's value to appreciate. However, there are challenges with value investing. Finding truly undervalued stocks can be difficult and requires significant research. Investors must also be patient, as it can take time for the market to recognize and correct a stock's price. Even with careful analysis, there are no guarantees of success, and the focus on value stocks can sometimes reduce diversification in a portfolio. Growth investing. It is all about seeking out investments that have the potential for substantial capital appreciation. This strategy focuses on companies that are expected to grow at an above-average rate compared to their peers. Instead of prioritizing current income or value, growth investors look for stocks that are poised for significant future growth, betting that their value will increase rapidly as the companies expand. Historically, growth investing has proven to be successful during periods when the economy is thriving and technology or innovation sectors are booming. Growth stocks can provide impressive returns as companies with expanding operations and new technologies often see their stock prices climb quickly. The strategy relies heavily on identifying businesses that are likely to experience rapid growth and capitalize on that potential for higher returns. There are clear advantages to growth investing. It offers the potential for significant capital appreciation over a relatively short period, which can lead to high returns if the chosen stocks perform well. This strategy typically requires less emphasis on detailed fundamental analysis compared to other approaches, as it focuses more on the potential for future growth and market momentum. However, growth investing also comes with its challenges. Growth stocks are often more volatile, meaning their prices can fluctuate significantly in short periods. They tend to have high valuations, which can make them more expensive compared to their earnings. Additionally, growth companies usually do not pay dividends in the short term, as they reinvest earnings into expanding their operations. The performance of growth stocks is also sensitive to macroeconomic conditions, such as interest rate changes or economic slowdowns. Momentum investing. Momentum investing operates on a high-energy principle. Buy what is trending up and sell what is trending down. This strategy focuses on identifying stocks that are showing strong upward movement and betting that these trends will continue. The core idea is to ride the momentum, hoping that stocks will keep gaining in value as long as the trend persists. Looking at historical performance, momentum investing has made a significant impact. The MSCI World Momentum Index, for instance, has consistently outperformed its benchmarks, with average annual gains around 10.75% since its launch. This impressive track record demonstrates how effectively momentum investing can harness market trends to deliver robust returns, provided the strategy is applied skillfully. The strategy comes with notable benefits. For one, it offers the potential for rapid short-term gains as you capitalize on prevailing market trends. The approach can also be engaging and relatively simple compared to more complex investing strategies, focusing on market signals and technical analysis rather than deep dives into company fundamentals. Additionally, momentum investing makes efficient use of short-term capital, allowing investors to potentially benefit from quick price movements. Yet there are also challenges to consider. Momentum investing requires a high degree of skill and precision to effectively time entries and exits. It's heavily dependent on market volatility. Without strong trends, opportunities may be scarce. Furthermore, the risk of sudden losses is significant, as trends can reverse quickly and dramatically impact stock prices. The strategy also introduces increased risk for short-term capital gains, which must be managed carefully. Dollar cost averaging, DCA. When it comes to investing, one method stands out for its simplicity and effectiveness: dollar cost averaging. This strategy involves making regular, fixed investments into a portfolio or fund, regardless of how the market is performing. By sticking to a set schedule, you purchase more shares when prices are low and fewer shares when prices are high, which can help manage the impact of market fluctuations over time. Dollar cost averaging has proven its worth through various market cycles. By investing a consistent amount regularly, you spread out your investment over different market conditions. This approach can help smooth out the effects of market volatility, reducing the risk of investing a large sum at an inopportune time. Over time, it can lead to a lower average cost per share compared to investing a lump sum all at once. The benefits of dollar cost averaging are quite compelling. It reduces the emotional stress of investing since you are committed to a fixed schedule, regardless of market highs or lows. This disciplined approach can lead to a lower average cost basis for your investments, potentially improving returns in the long run. Additionally, the strategy is relatively passive and straightforward, requiring less constant decision-making compared to other methods. However, dollar cost averaging does have its challenges. Automating this strategy can be tricky, especially if you are unfamiliar with your broker's platform or investment options. There is also a potential for increased future tax liability, as a lower average cost basis might result in higher taxes when you eventually sell. Maintaining a steady cash flow is crucial to keep up with regular investments, and periodic reviews of your investment strategy are necessary to ensure it continues to align with your goals. Dollar cost averaging is an excellent fit for investors who value a disciplined, systematic approach and can consistently make regular contributions. If you prefer to avoid the stress of market timing and are committed to a steady investment plan, this strategy may be just what you need. With the right knowledge and a solid strategy, you can weather any economic storm. Which of these investment strategies resonates most with you? Is there a particular strategy you're already using, or are you considering trying something new? Let me know in the comments below. And don't forget to hit that like button and subscribe for more financial tips. What financial topics would you like to see me cover in my next video? Let me know.